Two people, same city, same income, same starting point. One buys, one rents. And by the time we're done, the number that surprises you won't be the one you expected. Meet John and David. Both are 30 years old. Both earn $72,000 a year, which puts them at about $5,200 a month after taxes and basic deductions. They grew up in the same mid-size Midwestern city, went to similar schools, and landed comparable jobs. They've both been renting since their mid-20s, and they've each managed to save $55,000. Same starting line, different next move. John buys. He finds a 3-bedroom house in a solid neighborhood listed at $320,000. He puts his entire $55,000 into the down payment, which covers just under 17%. Because he's slightly under the 20% threshold, he'll owe private mortgage insurance until his equity reaches that level. He locks in a 30-year fixed mortgage at 6.75%. His principal and interest payment comes to $1,734 per month. Add property taxes at $310 per month, homeowner's insurance at $125, and PMI at $95 until he crosses the equity line. And John's all-in monthly housing cost on day one is approximately $2,264. David signs another lease. A comparable 3-bedroom in the same part of the city runs $1,575 per month. He keeps his $55,000 in cash, moves it into a total market index fund, and begins investing the monthly difference between what John pays and what he pays. That gap is $689 per month. He sets up an automatic transfer so he never thinks about it. On paper, David looks like he won before the game even started. Lower monthly cost, no debt, no maintenance exposure, and $55,000 in the market growing from day one. John, meanwhile, just handed his entire savings to a bank and signed a document committing him to 360 consecutive monthly payments. But here's the thing about paper. It doesn't capture time. The first 3 years are easy for David. His $55,000 at a historical average of 8% annually grows to roughly $69,300 by the end of year 3. His monthly contributions of $689 compound alongside it, adding approximately $27,700 in portfolio value during that same window. David's invested wealth at the 3-year mark is around $97,000. His total rent payments over those 36 months come to $56,700 with a 3% annual increase baked in. John's first 3 years look different on every spreadsheet. He paid $8,500 to $11,000 in closing costs before he got the keys. Lender fees, title insurance, prepaid escrow, attorney charges, none of which appear in any mortgage calculator. In year 1 of his $1,734 monthly principal and interest payment, roughly $1,575 goes directly to interest. Only $159 touches the loan balance in month 1. By month 36, that's improved slightly, but John has paid nearly $62,400 in total mortgage payments over 3 years, of which only about $6,100 has reduced what he actually owes. At year 3, if the home appreciates at a modest 3.5% annually, it's now worth approximately $346,000. John's remaining balance is around $249,000. His equity sits at roughly $97,000, but $55,000 of that equity came from his down payment, not from the market. The appreciation added approximately $26,000, and principal paydown contributed $6,000. David has $97,000 in liquid invested assets. John has $97,000 in a liquid home equity. On a spreadsheet, they look identical. In real life, they are not the same thing at all. David can rebalance, withdraw, or redirect his $97,000 anytime the market is open. John needs to either sell his house or take on new debt to access his. And selling means 5 to 6% in agent commissions on a $346,000 home, roughly $17,000 to $21,000 walking out the door before he sees a cent. That's the hidden tax on homeowner equity that almost no one factors in until they're sitting across from a real estate attorney. Now here's where the story starts to quietly shift. David's rent, which started at $1,575, increases to $1,622 in year 2, then $1,671 in year 3. Each individual increase feels trivial. It's $47. It's $49. It's the price of a dinner out. Nobody cancels a lease over $49. But the mechanism running underneath those increases is relentless. Rent growth doesn't stop. It doesn't plateau. It doesn't get fixed in place while the rest of the world moves on. It tracks inflation, local demand, and the landlord's cost basis. And it will do exactly that every year for as long as David rents. John's mortgage payment? $1,734 in principal and interest. That's the number on month 1. It's also the number on month 120, and month 240, and month 359. It doesn't care about inflation. It doesn't care about what rents are doing across town. It's fixed. And every year that passes, $1,734 buys less in real terms than it did the year before, because the dollars used to pay, it have been eroded by inflation. A payment that feels heavy at 30 often feels manageable at 40 and almost routine at 50. That's not a theory. That's what fixed debt does inside an inflationary economy. By year 5, David's rent has climbed to approximately $1,724. He's now paying $149 more per month than he was on day 1, and the gap between his payment and John's all-in cost has narrowed from $689 to around $540. His monthly contribution to his index fund adjusts down accordingly. The compounding tailwind he had in year 1 is beginning to thin. John, meanwhile, hit the equity threshold to remove PMI somewhere around month 38, which dropped his monthly cost by $95. Small move, but the direction is important. John's housing costs are moving toward him. David's are moving away. Let's jump to year 10. David's rent has grown to approximately $2,060 per month. His index fund, including the original $55,000 and a decade of variable monthly contributions that decreased as rent ate into the gap, has grown to approximately $208,000. Solid number. Real wealth. John's home is now worth roughly $452,000 at 3.5% annual appreciation. His mortgage balance after 10 years of payments has dropped to about $242,000. His equity is approximately $210,000. He's also spent somewhere between $35,000 and $50,000 on maintenance and repairs over the decade. A new water heater, exterior paint, a furnace replacement, and the gutters that failed 2 winters ago. That's real money. And it doesn't build equity. It protects it. At year 10, David has $208,000 in liquid investments. John has $210,000 in equity inside a $452,000 asset. The scoreboard looks almost even, but the trajectories are not. David is now paying $2,060 per month in rent and contributing a fraction of what he was at the start. John is still paying $1,734 in principal and interest, and his equity is compounding on a larger and larger base as the home appreciates. Leverage, the word that sounds like a finance class term, is actually just the mathematical reality that John is earning appreciation on $452,000, while David earns market returns on $208,000. They started with the same money. The asset base is now more than double. There's something else happening at year 10 that doesn't show up in any spreadsheet. David's landlord just informed him the building has been sold and will be converted to condominiums. His lease won't be renewed at the end of the year. He has to move. New search, new deposit, first and last month's rent, new commute calculations, kids switching schools mid-year. None of that shows up as a line item. But every person who has lived through it knows that the financial cost and the psychological cost are both real. John didn't move. His kids went to the same school for 6 years. He repainted the living room the color his wife actually wanted. He put a garden in the backyard. The stability isn't separate from the financial decision. It's part of it. Now we arrive at year 20. David's rent has compounded at 3% annually and now sits at approximately $2,760 per month. His portfolio, assuming he maintained discipline through 2 market corrections without panic selling and kept contributing through the years his rent was at its most aggressive, has grown to around $510,000. That is a genuinely strong outcome. It requires real behavioral consistency, no lifestyle creep, no missed contributions during volatile markets, no raiding the account when the transmission failed or the medical bill arrived. But assume David threaded that needle. $510,000 in liquid invested assets at age 50. John's home at year 20 is worth approximately $640,000. His mortgage balance has dropped to around $196,000. His equity is roughly $444,000. His monthly payment in principal and interest is still $1,734. His total housing cost, including taxes, insurance, and average maintenance, has risen in nominal terms, but in real inflation-adjusted dollars, it has been falling for 20 years. His property taxes have gone up with assessed value. His insurance has increased, but the core payment hasn't moved. The net worth gap at year 20. David, $510,000 liquid versus John, $444,000 in equity. David is technically ahead, and if you freeze the analysis here and call it a day, David looks like he made the smarter call. But year 20 is not the end of the story. John has 10 years left on his mortgage. In 10 years, that payment is gone. At year 30, John owns the home outright. A home that, at 3.5% annual appreciation from its current $640,000 value, will be worth approximately $902,000. His monthly housing cost drops to property taxes, insurance, and maintenance, roughly $850 to $1,050 per month. He is 60 years old. His largest monthly expense has effectively been cut by 60%. David at year 30 is paying approximately $3,700 per month in rent. His portfolio, if he maintained the same discipline through decade 3, could be worth somewhere between $820,000 and $880,000, a genuinely impressive number. But he will pay rent at $3,700 per month at 60. He will pay rent at 65. He will pay rent at 70 when his income is fixed, his Social Security is calculated, and his portfolio needs to last potentially 30 more years. Every dollar that goes to rent in retirement is a dollar not compounding. John's $850 monthly housing cost in retirement versus David's $3,700. That difference, $2,850 per month, is $34,200 per year. That's the invisible cost of having no finish line. And this is where the behavioral part of behavioral finance actually lives. Not in the spreadsheet. In what people do with money that isn't forced anywhere. John's mortgage payment went to the bank every month, whether he felt disciplined that month or not. He didn't have to remember, recommit, or override himself during a market crash. The equity built automatically, imperfectly, and reliably. David needed to invest $689 a month in January when the market was climbing. He needed to keep investing in October when it dropped 22%, and everyone on finance Twitter had a theory about why it was going to zero. He needed to not touch it when his car needed brakes, when his daughter needed braces, when his landlord raised rent again and his budget tightened. That kind of discipline exists. It's real. But it's rare. And the gap between what the model assumes and what humans actually do is where most of the rent vs buy math quietly falls apart. Now let's be honest about where buying breaks down, because this story isn't one-sided. If John had needed to move at year 4, job relocation, divorce, medical situation, the analysis reverses. Closing costs on entry, agent commissions on exit, minimal equity built in the early years. John likely loses money compared to David in any scenario shorter than 5 to 7 years. The break-even horizon is real, and ignoring it is how people make expensive mistakes. If John had bought in a market where appreciation ran at 1% instead of 3.5%, a stagnating regional economy, a shrinking city, an oversupplied market, the leverage that powered his equity becomes the same mechanism that traps him in a depreciating asset he can't easily exit. Concentration risk in real estate is real. David's index fund owns thousands of companies across dozens of sectors. John owns one building on one street. That asymmetry matters most when the local market moves against you. And if John had stretched beyond what his income could comfortably support, bought at $420,000 instead of $320,000, or bought with an adjustable rate that repriced upward, the fixed payment that became his quiet advantage turns into a fixed obligation that becomes his slow financial suffocation. The house itself isn't the point. The structure of the decision is. Here's what this comparison actually reveals. And it's not which choice wins. John and David made the same amount of money. They started with the same savings. One of them built wealth by locking in a fixed obligation against an appreciating asset in an inflationary world. The other built wealth by staying flexible and letting capital compound freely in liquid markets. Both paths generate real wealth. Neither is irrational. What determines the outcome isn't the strategy. It's the execution, the timeline, the market, and the behavior. The question that changes everything in this analysis isn't, should I rent or buy? It's two questions that most people never ask clearly. First, how long are you actually going to stay? Not how long you hope to stay. Not how long the plan assumes. How long will you genuinely stay? Because below 5 years, buying is almost never the better financial decision when you account for the full transaction cost. Second, if you rent, what actually happens to the difference? Not in the model, in your life. On the Tuesday in November, when your rent went up and your portfolio is down 15%, and there's a weekend trip that costs exactly what you were supposed to invest, what do you actually do? The math in this video is honest. Both outcomes are real. The gap between them isn't determined by the market. It's determined by the gap between what people plan to do and what they actually do when the plan meets friction. John didn't win because he bought a house. He won because buying a house automated a savings behavior that 30 years of market history shows most people struggle to maintain voluntarily. David didn't lose. If he invested consistently, he built over $800,000 in accessible wealth. That outcome is real and it's achievable. It just requires something the mortgage never asks for: sustained, voluntary discipline over 3 decades. The most expensive financial decision isn't renting. It's not buying either. It's making a major, long-term financial commitment based on what's comfortable in month 1, and never running the numbers forward to see what comfortable becomes by year 20. Run the numbers forward, all the way to the end. That's where the real answer lives.